In this video, traders, we're going to look at how do you find trades with a good risk-reward ratio. Stay tuned. Hey guys, a very warm welcome to you. All right, so risk-reward ratio, as you know, or maybe you don't know, but is key. So we really want to find trades where we're risking 1 to make 3, for example, and that would be a 3-to-1 risk-reward ratio, and that's the kind of thing we want. So if you're risking, let's say you're risking $100, you want to be making $300 plus, and that'd be a 3-to-1 risk-reward ratio. You're making 500, 5-to-1, etc. You get the idea. Now the reason this is so good is that you can afford to be wrong a lot of time, but still make money. So we want trades with a high risk-reward ratio. Now, the trap that we can fall into as traders is we go, right, I want a high risk-reward ratio. I'm going to look at this trade. Here we go. We're finding some support here. Oh, great. I want to buy at support here. I'm going to have a stop under here, and I want to target here. That gives me a nice 10-to-1 risk-reward ratio. But the trouble is that you are just literally deciding risk-reward ratio based on what you want to achieve. So you're reverse engineering it. So you're saying, okay, I want to have 10-to-1. All right, so my stop is going to be here. And by the way, guys, your stop, should be in a sensible place. We'll get to that in a moment. But let's say your stop is here. You're saying, oh, well, 10 times that makes my target here. So I want to hit that target, by tomorrow. And you just never hit it because the market's just never going to suddenly change the way that it acts. It's not going to suddenly have a massive volatility expansion, not just going to suddenly come up and hit your target. So it's a pie in the sky. You're just stabbing at it going, you know what, I know I've got to have a good risk-reward ratio. Well, I've got 100-to-1, my target's up here. You get the idea, guys. You can't force the risk-reward ratio that you want. You have to look at the trade that's setting up and then see if it has the right risk-reward ratio for you. So how do we do that? How do we find these trades? So the first thing is we look at the stop position and we say, right, where logically has the stop got to be for the thesis of the trade to be negated? In other words, where is the trade no longer valid? So if we were buying this at support, a great example, if we're buying this at support here, okay, where? Okay, we'd probably say, well, if it goes under support, then I'm going to be out. But you don't want it too close, otherwise you're going to get tagged by a wick. So maybe you've already had a wick. Let's say for argument's sake, you've already had a pullback here and it's back up. You say, okay, well, if it goes back under that wick, under the support, I'm out. Whatever that may be. Imagine that is 50 pips, right? That's 50 pips. You go, okay, so there's my new trading forex, 50 ticks, 50 cents, whatever market you decide to trade. 50 pips. Right, now you go, okay, now how do I work out what's going on? So my stop is the first port of call. I have an anchor point, that's my risk. And by the way, that monetary amount then comes down to how much you're trading. You're trading £2 a pip, you've got $100 risk there, 200 pounds risk. I'm switching currencies in my mind. You get the point, trading $2 a pip, etc. So you can say, right, that's my risk. It's 100. I'm going back to my $100 here risk, and it's 50 pips, so I know I can do $2 a point if I'm using spread betting or whatever it is. So fine. Now the next part of it to see if this trade is still valid is to go, right, I need at least the 3-to-1 to take these trades. I don't want to take anything less. Where's it going to go to? Right, so you start to then extend it and go, well, there's 1-to-1. There's 2-to-1, there's 3-to-1, and you go, right, that's where I really need my thing, because that's 50 pips, that's 100 pips, that'd be 150 pips. So I really need that. So the minimum I can have is going to be there. Now, is that feasible? On this chart, it probably is, because you could say, you know what, actually, if that support holds, I would expect us to break above the high. And I'm not asking for much. I'm not asking for here straight away. And there's nothing wrong with that, but just with the context of what you're given, and the context of what we're given in this kind of example chart that I've just scrawled on here, guys, is that, yeah, you know what? If you broke through that resistance level and popped through with a day of aggression, which is normal market conditions, you'll probably get your 150. So in which case you go, yeah, I can take this trade. It ticks my boxes. It makes a lot of sense. Now, if we imagine this same scenario, let's just rub some of this off and get a bit of a dirty whiteboard finger here. Imagine this same scenario was here. We did this. All of a sudden we go, right, well, actually our stop has got to be here really, because we're trading off that. Now that might be 150. Okay, well, if you want 3 to 1, what do we want? We want 450 pips return, don't we? 150, 300, another 150. We need 450 back. Where's that got to be? Well, in reality, there's our 150, there's our 300. We're actually where we were before, right up here. Now, what's the chances of price getting to that in our time frame expectancy? Of course, price can get to that over a long period of time. We're not saying it hasn't, but in the rules of our expectancy, we're saying, okay, well, it's a 5-day period there. You know, we'll have to continue on. Is it feasible? It's probably not. It's probably not feasible for us to take that trade and expect a 3 to 1. We're probably going to take that trade and we still have the same target and it's not enough. You know, it's only giving us 2 to 1 there, or it's giving us 1.5 to 1, or whatever the number may be. So we then look at another chart and we go, right, well, where can I express this trade with the least amount of risk possible and the most sensible and obvious reward position? You know, because then we can start to really pick the trades that work, because we can't force the market to give us the pattern that we actually want. We can't force it. We can, of course, we can jump the gun, we can make mistakes and go, well, actually, I'm going to put my stop here. But we should be wrapping our trade around what the pattern is showing us. If it's showing us a nice little wick to the downside that pops up and it's a shallow wick and it's done that and it's past the prior day, whatever, then great, we take that and now we look at the target. Is it feasible that we break the high if we've done a fake through low? Yeah, very feasible. You know, is it feasible that we rip up and hit that and the next day? Probably not. Could chug up there, could it chug up there in the next couple of weeks? It could do, but then again, is that in line with what we've seen has happened? So thinking about you know, what the chart is showing you and hunting for those. So, you know, the way to hunt for them is to have your strategy in mind, whatever that may be, have your stop idea in mind. Let's say you're buying a double bottom. So you're scanning through your charts, you're looking for double bottom, then you're looking to see how much is the risk on the trade. Okay, and then you're eyeballing and saying, where's my price target? Where can my price target be? Okay, is that, no, next. So you're always looking at your stop first and then your feasible price target second, and that's how you hunt for those high risk reward ratio trades. Now, we might ask, well, what's the strategy for that? What's the operational tactic for doing that? That's going to be different depending on what market you're trading. If you're trading a basket of forex pairs, should I say, you're just going to be able to scroll through. You might have got 10, 20 pairs. You should scroll through, use eyeball. If you're trading shares or stocks, you probably have a screening system to bring them for your attention, and that may well be something like their all-time highs, they're away from the moving average, they've got this, they've got that, and that's going to be personal to you. And the guys have done videos, we talked about that before. The point is that you're looking through and just seeing where that stop is and then extrapolating that and go, hey, is that going to be a sensible target? Because the trap we fall into again is we force our target onto something that's never going to be there. And now we're going, got to run the trade, got to run the trade, got to run the trade, got to run the trade. We're told to run our winners. And of course, we're expecting too much. The market goes up a little bit, comes back, and then it's in a completely different scenario. So it comes back, does its thing, and then, you know, from here onwards, it's in a different phase. It's in a different phase. That was the move. You know, you should have grabbed that, and really when it was up there, that was the trade to take. But now it's in a different phase, it does what it wants, it's a different type of trade. So bear that in mind, guys. Risk reward ratio, super key. Take care, see you next one. Bye-bye.